You're about to learn how to take control of your money and make it work for you. Today, you'll discover practical steps that successful people use every day to earn faster, invest smarter, and grow their wealth steadily. By following these strategies, you'll gain clear methods you can start applying immediately to see real results. From identifying opportunities to acting quickly, from understanding market moves to making investments that multiply your money, this video breaks down every step into simple, actionable guidance. You'll get tips on saving effectively, reinvesting profits, and spotting deals that others miss. These are habits and techniques that build confidence, discipline, and long-term financial security. Stick around to learn methods you can use daily to improve your financial life. Subscribe for more content from Audiobook Shift, where every video gives you tools to take action and grow consistently. Number 1. Identify opportunities. Act quickly. Earn consistently. The first thing to understand is simple. Opportunities are everywhere, but they rarely announce themselves. The skill that separates people who earn quickly from those who only dream about it is the ability to notice patterns, take action within a clear framework, and keep moving when results are imperfect. This chapter focuses on training your attention, creating reliable decision rules, and building habits that transform small chances into steady cash. It emphasizes practical steps you can take immediately and the inner discipline needed to do them consistently. Start by sharpening your vision. Spend 1 hour each morning scanning 3 focus sources that match your skills or interests. If freelancing is an option, check 2 job boards, 1 niche forum related to your skill, and the messages in your network. If physical flipping appeals, scan a local marketplace, an auction site, and a clearance page of a major retailer. If investing suits you, pick 1 reliable financial news source, 1 market screener, and 1 earnings calendar or fundamentals page. The point is not to drown in information, but to create a habit of deliberate scanning. Set a timer for 60 minutes and treat this as purposeful reconnaissance. Notice what patterns repeat. An item that appears underpriced twice in a week, a job requiring a skill you can deliver this month, or a stock repeatedly overlooked by analysts. These are early signals. Turn signals into rules. Rules remove hesitation. Create 3 decision rules you will follow rigidly for short-term opportunities. For example, 1. If an item on the local marketplace is priced at least 40% below recent comparable sales and shipping is cheap, buy it and relist within 3 days. 2. If a freelance job pays at least 20% more than your usual rate and can be completed within 7 days, send a tailored pitch within 2 hours. 3. If a stock meets your preset value metrics and the position size will not exceed 2% of your total capital, place the trade during the next trading window. These rules are not rigid because they are perfect. They are rigid because they remove the paralysis that kills momentum. When the clock is ticking and emotions rise, rules keep you focused on what you control. Prepare a short due diligence checklist for the type of opportunity you pursue. Keep it to 5 items max, so it can be completed quickly. For flipping physical goods, the list might include: verify item condition with photos, confirm comparable recent sale prices, calculate all fees and shipping, check seller's rating, and set minimum acceptable profit. For freelance work, read client profile, list deliverables and timeline, identify required tools, estimate hours, and calculate minimum acceptable pay. For investing, verify financials quickly, check recent news for material events, set target entry and exit, estimate worst-case loss, and size the position. A compact checklist prevents mistakes born from haste and keeps speed aligned with prudence. Move fast, but manage risk. Action without protection is gambling. Adopt a simple risk limit for every quick-earn strategy. For physical flips, never let inventory exceed the amount you can store comfortably or fund without stress. For gigs, cap your work in progress so quality does not collapse. For investments, use position sizing and a stop-loss level that you can emotionally accept. Stoic discipline means focusing on the process, not the outcome. Define what loss you will accept before making a move, and honor that threshold. Losing a small amount now is vastly preferable to an emotional meltdown that blocks future choices. Execution matters more than perfection. When an opportunity meets your rules and passes the checklist, act immediately. Time box the execution. Prepare your purchase or pitch within 30 minutes. Relist or follow up within 24 hours and track the result. The physical sensations of action are instructive. The tightness in the chest before hitting send, the relief when the first sale clears, the tiny satisfaction of a documented profit. Those sensations form the feedback loop that trains you to move again. Efficiency compound. Completing 5 quick, well-executed actions in a row creates momentum that leads to better and faster judgment. Use small experiments to scale learning. Treat each action as a test with measurable outcomes. Record 3 variables: time invested, money outlay, and result. After 10 experiments, review what worked and what failed. Which channels produced the highest success rate? Which types of offers converted fastest? Which errors repeated? Adjust the rules and checklist based on this honest, disciplined review. Growth is not about waiting for a perfect plan. It is about running short, repeatable experiments and improving the playbook. Leverage the network effect. Opportunities often arrive through people. Make a practical plan to reach out to 10 new contacts per month with a concise value proposition. This can be as simple as a short message offering a small, immediate benefit, a free 1-hour consultation, a discount on a first project, or a referral for someone else. Keep follow-ups brief and scheduled. When people trust you to deliver quickly and well, referrals increase and rapid earn opportunities multiply. Remember the Stoic aim. Control what you can, the quality of your work and your responsiveness, and accept what you cannot control, like time. Automate the mechanical parts. Speed requires systems. Use templates for common tasks. A pitch template that can be personalized in 5 minutes. A checklist template for verifying items. A spreadsheet that calculates profit after fees automatically. Set alerts for price drops or new listings that match filters. Automations free attention for judgment. The quieter parts of your routine should be handled automatically so your sharpest energy goes to decisions that matter. Keep a daily practice of emotional calibration. Rapid action triggers stress. Develop a simple ritual to regain composure. A 1-minute breathing exercise, a short walk around the block, or a quick review of the day's rules written on an index card. When a trade dips or a buyer cancels, this habit prevents escalation into panic. Stoic wisdom teaches that emotions are responses to impressions. By stepping back and observing feelings without immediate reaction, clearer choices follow. Manage cash flow deliberately. Quick earn strategies often require working capital. Track a separate opportunity fund and limit it to a percentage of your overall savings. Replenish it from profits, not from emergency money. Treat profits as tools. Allocate a portion to the opportunity fund, a portion to longer-term savings, and a portion as immediate reward for motivation. This simple allocation habit turns sporadic wins into sustainable resources that fuel further action. Create templates for offers and negotiations. A strong, clear first message wins more than polished, but vague proposals. For sales, present 3 options: a basic, a standard, and a premium. For freelancing, include clear deliverables, time estimates, and a simple pricing table. For reselling, create a listing template highlighting condition, authenticity proof, and shipping options. A clear proposal cuts back and forth and shortens the path from opportunity to income. Accept failure as tuition. Not every move will succeed. When a strategy fails, extract the lesson and decide: abandon, tweak, or double down. Use a simple rule of 3. If a method fails 3 times for the same reason, stop. If it shows partial success, refine the checklist and try again. If it consistently performs well, scale it gradually. This triage process keeps learning targeted and efficient. Finally, cultivate the daily discipline that turns occasional gains into reliable income. Show up to the scanning hour, obey your rules, complete your checklists, and run experiments with curiosity and patience. The Stoic core here is focus on what you can control: your effort, your clarity, and your response to results. Success is not a single spectacular win. It is the slow accumulation of correct behaviors practiced under pressure until they become automatic. Actionable summary to begin today. Block 60 minutes tomorrow morning to scan 3 relevant sources, create 3 decision rules, and write them on an index card. Build a 5-item checklist for your first chosen strategy. Define a risk limit you can accept, and schedule a 10-minute review after 5 experiments. Those small, concrete steps create the structure that makes speed reliable. The path to earning quickly is not a sprint fueled by wishful thinking. It is disciplined attention and efficient action repeated until the system produces consistent results. Train your senses to spot opportunity, bind your actions with rules, protect your downside, and learn from every outcome. Over time, the same daily habits will produce more than quick money. They will develop the confidence and tactical wisdom that open better, larger opportunities. Keep doing the work. The process rewards those who prepare, decide, and act with calm speed. Number 2, research markets deeply, invest wisely, profit. Understanding how to make money fast is only part of the equation. The other part, equally critical, is knowing where to put your money so it grows rather than disappears. Researching markets deeply and investing wisely is a skill that separates amateurs from professionals, and it is accessible to anyone willing to commit focus, time, and discipline. This is not about gambling on luck or following trends blindly. It is about cultivating insight, building knowledge, and making decisions grounded in facts, patterns, and logical judgment. The more informed your choices, the higher the probability of profit and the lower the risk of catastrophic loss. Begin with curiosity. Approach every market you consider as a puzzle to be solved, not a lottery ticket. Whether it is stocks, real estate, cryptocurrencies, or collectibles, every market has its own language, rhythm, and structure. Your first step is immersion. Spend time reading reports, tracking price movements, studying historical performance, and observing how market participants react to news, policy changes, or economic events. Keep a notebook to record observations, patterns, and anomaly. These notes are not academic. They are your personal map of opportunity. The discipline of recording details forces focus and builds a deep, intuitive understanding of where value truly lies. Next, focus on fundamentals before emotion. Emotions can be the quickest path to loss. Human behavior in markets tends to amplify fear and greed, often creating temporary distortions. A deep study of the fundamentals allows you to distinguish noise from real opportunity. For a stock, this means looking at revenue growth, profit margins, debt levels, and management quality. For real estate, it involves neighborhood trends, rental yields, property taxes, and long-term development plans. For commodities or cryptocurrencies, it is about supply-demand dynamics, adoption trends, and regulatory environment. Make a list of the key metrics for any market you enter, and ensure that each investment satisfies these metrics before committing capital. Practice comparative analysis. Rarely is there only one option. Always compare multiple choices within the same market. If you are looking at stocks, examine 3 to 5 companies within the same sector to determine which one has the strongest balance of growth, stability, and undervaluation. For real estate, compare properties in different locations considering potential appreciation, vacancy rates, and maintenance costs. Comparative analysis helps you prioritize where your resources will achieve the highest return for the least risk. It also strengthens your judgment, enabling you to spot anomalies and exploit them before the wider market notices. Develop a systematic approach. Investing wisely requires structure. Without a framework, decisions become reactionary and inconsistent. Define a clear method for evaluating any opportunity. What data points matter most, how you weigh them, what thresholds indicate a buy or sell, and how you determine acceptable risk. Stick to this method consistently. A repeatable process is your safeguard against emotional decision-making. Discipline and research allows you to identify opportunities others overlook and to act with confidence when the moment arrives. Pay attention to timing. Knowledge alone is not sufficient. Knowing when to enter and exit is equally important. Monitor liquidity, market cycles, and momentum. Sometimes a fundamentally strong asset may not be a good purchase simply because the timing is off, whether due to temporary overvaluation, seasonal trends, or macroeconomic conditions. Cultivate patience alongside urgency. Quick profits come not from impulsive decisions, but from waiting for the alignment of preparation, knowledge, and timing. Leverage information wisely. The goal is to transform data into insight. Do not get trapped in endless consumption of news or social media speculation. Identify primary sources of information, official filings, industry reports, economic indicators, and credible analysts. Cross-check data across sources to avoid bias and misinformation. Develop a habit of questioning every claim and verifying facts before acting. This habit not only reduces mistakes, but also sharpens your intuition, allowing you to sense when a market narrative is overblown or underappreciated. Risk management is inseparable from profit. Understanding the market deeply means knowing both its opportunities and its dangers. Determine your maximum acceptable loss for each investment and adjust position sizes accordingly. Diversification is not simply spreading capital across many assets, but allocating it thoughtfully to reduce correlated risks. Protecting capital is the first step in ensuring the opportunity to profit repeatedly. Every loss is a lesson, but repeated heavy losses are a failure of preparation, not chance. Observe and learn from the professionals. Study the methods of successful investors and traders, but do so critically. Don't mimic blindly. Identify principles that make sense for your level of expertise and the type of market you operate in. Notice patterns in their research, timing, and risk assessment. Distill these insights into your own system, improving it with each observation. True mastery is not imitation, but test strategies in small scale first. Knowledge without application is theoretical. Before committing large sums, implement a trial run. If investing in stocks, use small position sizes or simulate trades. If flipping real estate, start with a single property or a low-cost repair project. If exploring commodities or crypto, begin with minimal allocation. Document every action, result, and deviation from expectation. This practice refines your system and builds confidence while limiting potential loss. Develop a feedback loop. Regularly review outcomes and adjust methods. Analyze why profitable investments succeeded and why others failed. Focus on metrics rather than feelings. Ask, did the research process detect the opportunity correctly? Were risk limits respected? Was timing optimal? Use each review session to strengthen your rules and processes. This iterative improvement is the engine behind sustainable profit, converting experience into wisdom. Balance speed and thoroughness. While the first chapter emphasized acting quickly, deep research demands patience. The tension between fast execution and thorough analysis is the hallmark of professional investing. You cannot shortcut understanding without increasing risk, yet delaying action excessively reduces opportunity. Learn to find equilibrium. Build a system that allows rapid assessment without skipping crucial evaluation. Efficiency comes from preparation, not recklessness. Embrace mental resilience. Markets are unpredictable, and even the most informed investments will sometimes underperform. Stoic principles are invaluable here. Focus on what you control. Research quality, process adherence, and emotional discipline, and accept what you cannot control. Market volatility, macro shifts, or unexpected events. Resilience allows you to maintain rational judgment in the face of setbacks and prevents temporary losses from undermining your long-term trajectory. Actively seek learning from every move. Every investment, whether it succeeds or fails, contains lessons. Review trends you missed, miscalculations you made, and surprises you encountered. Integrate these lessons into your framework. Over time, your understanding of market dynamics will deepen and opportunities will become increasingly obvious. Experience, when consciously examined, compounds like money itself. Finally, connect research with action. Knowledge is useless unless it is applied strategically. Build a routine, research consistently, evaluate opportunities with defined criteria, test small, scale intelligently, and manage risk. Ensure every action stems from a disciplined process rather than impulse. With repetition, this transforms into an intuitive sense of what is likely to yield profit, creating both speed and precision in decision-making. Today, the first practical step is to select one market that interests you most. Commit to studying it for 1 week without making a single trade. Track prices, identify 10 potential opportunities, and document the fundamentals of each. Build your evaluation checklist, noting metrics that matter most. At the end of the week, review your findings critically, then act on the best opportunity within your defined risk limits. This simple, focused approach lays the foundation for a lifetime of informed, disciplined, and profitable investing. Mastering the combination of deep research and wise investment is not a secret reserved for a few. It is a discipline, a practice, and a mindset. By observing the market carefully, evaluating opportunities rigorously, and acting intelligently, you create consistent profit potential. The path to wealth in any market is paved with preparation, knowledge, patience, and measured action. This is how ordinary effort transforms into extraordinary results. Through this process, profit becomes a reflection of skill, insight, and persistence, rather than chance alone. Number 3. Diversify strategies, minimize risk, maximize returns. True financial growth rarely comes from a single source. Relying on one method or one market exposes you to unnecessary risk, while spreading your efforts intelligently allows for resilience, stability, and the compounding of opportunities. Diversifying strategies is not simply about having multiple streams of income. It is about structuring them so that each complements the others, reduces vulnerability, and positions you to capture maximum upside. This approach requires thoughtful planning, disciplined execution, and continuous assessment, but it yields a level of security and freedom that is unattainable through narrow focus alone. Start by analyzing your current capabilities and resources. Identify the types of opportunities you can realistically pursue given your skills, time, and capital. For example, you may have expertise in digital services, a small savings buffer, and the ability to dedicate a few hours daily to trading or investing. Recognizing these assets allows you to craft a set of strategies that are achievable and scalable. Diversification is not about spreading yourself thin. It is about leveraging existing strengths across different arenas in a coordinated way. Consider combining active and passive strategies. Active strategies require hands-on effort and time, such as freelancing, buying and selling goods, or short-term trading. Passive strategies generate returns with minimal day-to-day intervention, like dividend stocks, index funds, or long-term property rentals. Balancing these approaches ensures that while one strategy is subject to market fluctuations or time constraints, another continues generating value steadily. Over time, this combination builds stability while keeping you engaged with dynamic opportunities. Explore different markets and asset classes. Dependence on a single market exposes you to sector-specific risks. Stocks may fluctuate with economic cycles. Real estate depends on location and polities, and commodities react to global supply shocks. By allocating resources across distinct markets, you reduce vulnerability. The key is not random allocation, but informed selection. Each market chosen should complement your other investments, while offering unique growth potential. Track correlations between assets to ensure that declines in one area are mitigated by stability or growth in another. Risk assessment becomes central in a diversified approach. Each strategy carries its own inherent risks, and understanding them allows you to manage exposure intelligently. For example, high-reward short-term trades might be balanced by low-risk investments with predictable returns. Establish clear rules for maximum exposure per strategy, percentage of capital allocated, and conditions for exiting underperforming ventures. Structured risk management protects your portfolio from catastrophic losses and ensures that you retain the ability to capitalize on future opportunities. Develop a system for scaling each strategy. Start small to understand dynamics and refine your approach before committing substantial resources. Track performance metrics diligently: time invested, net return, and risk encountered. Once a strategy demonstrates consistent results and manageable risk, gradually increase scale. This gradual expansion preserves capital while building confidence. Scaling multiple strategies in parallel requires careful attention, but over time it multiplies the effectiveness of your efforts, creating an ecosystem of income streams that reinforce each other. Leverage complementary strategies. Some approaches work best when paired with others. For instance, learning about short-term market trends may enhance your ability to spot undervalued long-term investments. Running a small online business could fund experiments in trading or investing without needing external capital. Identifying synergies allows each strategy to reinforce the others, creating a network of activities that increases efficiency, reduces downtime, and amplifies return. Automate or systematize repetitive tasks where possible. Diversification increases complexity, and managing multiple strategies manually can quickly become overwhelming. Use technology to track investments, monitor performance, and execute routine operations. Templates, alerts, and automated calculations free mental bandwidth, allowing you to focus on strategy development decision-making rather than tedious administration. Systemization ensures that expansion does not lead to chaos and that opportunities are acted on with precision and speed. Maintain continuous education. Each strategy, market, and tool evolves over time. Staying informed about changes ensures that your diversified portfolio remains effective. Follow credible news sources, study market reports, and analyze performance trends. Regularly revisiting and updating your approach prevents stagnation and allows you to anticipate shifts rather than react to them. Lifelong learning is the foundation of sustainable financial growth, especially when managing multiple strategies simultaneously. Track interdependencies carefully. Diversification can be undermined if strategies are indirectly correlated. For example, multiple investments that rely on the same economic factor may appear diversified but actually move in tandem when conditions change. Identify hidden correlations and adjust allocations to ensure true independence among strategies. This increases stability and reduces the likelihood that a single market event will cascade into multiple losses. Practice disciplined evaluation. Establish a routine for reviewing each strategy individually and collectively. Assess performance against predefined benchmarks. Analyze risk-adjusted returns, and identify areas for optimization. Make decisions based on data, not emotion. Cut strategies that consistently underperform despite adjustments, and allocate resources to those that demonstrate resilience and growth potential. Continuous evaluation strengthens your system, ensuring that diversification remains purposeful and profitable rather than accidental. Balance complexity with manageability. While it is tempting to pursue every promising opportunity, true diversification focuses on quality over quantity. Limit the number of active strategies to what can be monitored and manage effectively. Deep engagement with a manageable set of approaches often yields better results than shallow attention to many. This disciplined selection maintains clarity, reduces stress, and allows each strategy to develop to its full potential. Consider time horizons for each strategy. Some approaches yield results quickly, while others compound value over years. Balancing short-term and long-term perspectives allows cash flow for immediate needs, while building wealth that grows steadily. Short-term gains can be reinvested into longer-term ventures, accelerating overall growth. Understanding time dynamics enables smarter allocation of resources and ensures that your diversified system supports both immediate action and future security. Cultivate emotional resilience across strategies. Juggling multiple approaches exposes you to more fluctuations and potential setbacks. Maintain detachment from individual outcomes, focusing instead on the strength of the system as a whole. Stoic discipline teaches that consistent adherence to principles and processes will yield results, even if individual actions temporarily disappoint. Emotional control prevents impulsive shifts that can undermine long-term stability. Integrate feedback loops for learning. Each strategy should generate data about what works and what does not. Document performance metrics, note lessons learned, and incorporate them into future planning. Over time, your ability to evaluate and adjust grows sharper, enabling more precise decision-making and more efficient deployment of resources. Feedback turns experience into actionable insight, making each new endeavor less risky and more productive. Leverage compounding across strategies. Successful diversification allows gains from one approach to fund expansion in others. Profits from a short-term project can finance a long-term investment. Passive income streams can support experimentation and higher risk opportunities. The cumulative effect of reinvesting across complementary strategies multiplies growth, transforming modest efforts into substantial results over time. Finally, view diversification as a living system rather than a static plan. Markets, opportunities, and your own capacities evolve constantly. Regularly reassess alignment between strategies, adjust for changes, and remain flexible without abandoning discipline. A diversified approach is not about spreading energy aimlessly. It is about building a resilient, adaptive framework that maximizes returns while minimizing exposure to unnecessary risk. Today, begin by listing all potential strategies you can realistically pursue. Categorize them into short-term, medium-term, and long-term based on effort, liquidity, and expected returns. Define clear risk limits and success benchmarks for each. Start implementing one or two strategies immediately on a small scale while continuing research on others. Document every result and review progress weekly. Over time, this disciplined layering of strategies builds both confidence and financial stability. The power of diversification is that it transforms uncertainty into opportunity. By approaching multiple avenues simultaneously, minimizing correlated risk, and managing each element with careful attention, you create a system that thrives in varied conditions. This method does not eliminate effort or require extraordinary luck. It demands consistent action, critical thinking, and disciplined allocation. Done correctly, it amplifies potential returns while reducing vulnerability, providing both immediate results and long-term financial security. Number 4. Flip assets smartly. Reinvest. Compound growth. Flipping assets is one of the most powerful ways to generate rapid income and create compounding wealth, but it requires careful strategy, disciplined execution, and a mindset focused on growth rather than instant gratification. At its core, flipping is about identifying undervalued resources, transforming them or positioning them effectively, and then converting them into profit that can be reinvested. Success is not based on chance. It comes from developing systems that consistently uncover hidden value, execute efficiently, and leverage each gain to expand your capacity for future opportunities. Start by developing a keen eye for value. Whether the asset is physical, digital, or financial, the ability to discern underappreciated potential separates consistent earners from the crowd. This involves studying past transactions, tracking price trends, and understanding demand patterns. For physical goods, inspect condition, brand reputation, scarcity, and desirability. For digital assets, assess content quality, audience engagement, and market growth. For financial instruments, examine market fundamentals, liquidity, and volatility. The objective is to train your perception so that opportunities become immediately recognizable and distinguishable from poor choices. Prioritize speed and precision. Flipping relies on timing as much as judgment. An undervalued item may only remain available for a limited window. Fast assessment, decisive action, and efficient execution are crucial. Develop a process for evaluating any asset in minutes rather than days. Create checklists that outline key factors influencing value, calculate potential profit margins instantly, and set clear thresholds for what constitutes an acceptable deal. Discipline yourself to act when the numbers align with your rules rather than hesitating for perfection. Learn the art of negotiation. Even assets that appear undervalued may require skillful interaction to achieve the maximum return. Negotiation is about creating agreements that benefit both sides while protecting your margin. Be polite, assertive, and informed. Know the lowest price you will accept and the ideal price you aim to achieve. In digital or service-based flips, negotiation may involve structuring contracts, managing timelines, or enhancing perceived value. Every interaction should be approached with clarity and preparation, ensuring that you consistently maximize returns without overextending effort. Document and analyze every transaction. Each flip provides data that can refine future decisions. Record acquisition cost, fees, time invested, market conditions, and final sale price. Review patterns over weeks and months to identify which types of assets, channels, and timing yield the best results. Treat each transaction as a micro-experiment. Some will underperform, and others will exceed expectations. Systematic documentation allows you to replicate successes and minimize repeated mistakes, turning intuition into quantifiable strategy. Reinvest strategically. The essence of compounding is not merely earning profit, but redeploying it intelligently. After completing a successful flip, allocate proceeds to fund the next opportunity rather than spending all gains immediately. Define percentages for reinvestment, reserves, and personal reward, ensuring that the bulk of profit continues to fuel growth. This habit magnifies returns over time, allowing modest initial capital to snowball into substantial financial resources without reliance on outside funding. Diversify types of assets. Relying on a single category exposes you to market-specific risks. Combine physical goods, digital products, and financial instruments when possible. Physical goods can offer immediate returns but may require storage and shipping. Digital assets can scale without physical constraints, but require technical understanding. Financial instruments may offer leverage, but demand careful risk control. A diverse approach ensures stability and consistent opportunity, mitigating the risk that a downturn in one category derails progress. Understand market cycles. Assets fluctuate in value based on seasonal, economic, and social trends. Successful flippers anticipate these patterns rather than react to them. Study historical sales data, follow relevant communities, and monitor external factors that influence demand. By recognizing cycles, you can acquire assets at low points and sell when interest peaks. Timing amplifies returns, transforming small margins into meaningful profits. Awareness of cycles also informs risk management, preventing overinvestment during periods of temporary inflation and perceived value. Streamline logistics and reduce friction. The faster and smoother each flip occurs, the more profit you retain. For physical goods, optimize storage, shipping, and listing processes. For digital assets, standardize file management, content transfer, and platform handling. For financial instruments, automate trade execution where possible. Efficiency reduces costs, saves time, and allows you to focus energy on identifying additional opportunities rather than managing avoidable complications. Each improvement compounds over time, turning small operational gains into significant cumulative advantage. Leverage small wins for bigger opportunities. Early successes, even modest ones, build both capital and confidence. Use these wins to tackle progressively larger or more complex flips. As proficiency grows, reinvestment capacity expands, creating a natural scaling effect. The psychological momentum from repeated small victories also strengthens decision-making, reduces hesitation, and reinforces disciplined action, all of which are essential for compounding growth. Maintain a disciplined mindset. Flipping can be exhilarating, but emotional attachment or impulsive decisions undermine results. Approach every asset analytically, set clear entry and exit criteria, and adhere strictly to them. Stoic principles emphasize focusing on controllable actions rather than unpredictable outcomes. Profits are the reward for consistency, not luck. By managing your mindset, you maintain clarity, prevent rash moves, and protect your capital. Continuously improve market knowledge. Each type of asset behaves differently, and expertise develops over time. Observe trends, track demand fluctuations, and stay aware of innovations that create new opportunities. Attend workshops, read reports, and engage with communities related to your chosen assets. Every insight gained reduces risk and increases efficiency, enhancing both short-term profits and long-term strategic positioning. Consider risk-adjusted scaling. Increasing investment size can multiply profits, but unchecked escalation exposes you to outsized losses. Scale each strategy gradually, analyzing outcomes and refining processes before committing larger resources. Position sizing should reflect confidence in the process, not greed or impulse. This cautious but deliberate approach allows compounding to occur steadily, protecting gains while expanding potential returns. Build systems for repeated execution. Successful flippers often operate like mini factories. Sourcing, Evaluating, acquiring, enhancing, and selling are organized into repeatable workflows. Systemization reduces error, speeds execution, and frees cognitive energy for strategy development. Templates, automated tracking, and standardized procedures ensure consistency across multiple flips, creating a foundation for predictable and scalable growth. Analyze competitive behavior. Understanding how others operate in the same market provides insight into pricing, demand, and supply dynamics. Study what assets are being flipped, which platforms are preferred, and how offers are structured. Identify gaps or inefficiencies you can exploit. Competing effectively requires observation, adaptation, and careful positioning rather than mere imitation. Use competitors' successes and failures as lessons to refine your own approach. Create feedback loops for reinvestment decisions. Each flip provides information on what works best under current conditions. Use this data to determine where to allocate capital next. Continuously adjust strategies based on outcomes, refining your process and optimizing allocation. The act of reinvesting intelligently turns a sequence of individual transactions into a self-sustaining growth engine. Balance short-term profits with long-term value. While immediate cash flow is important, some flips may offer longer-term gains that compound more substantially. Assess opportunities not just for immediate margin, but for potential appreciation or recurring benefits. This balance allows your capital to generate returns across multiple time horizons simultaneously, accelerating overall growth while maintaining liquidity for other opportunities. Develop resilience against setbacks. Not every flip will succeed, and losses are inevitable. Anticipate occasional failures and incorporate protective measures, clear exit strategies, contingency plans, and predefined loss limits. Use setbacks as learning tools rather than sources of discouragement. By maintaining perspective and continuing disciplined action, losses remain temporary obstacles rather than permanent setbacks. Today's action is clear. Identify one asset type you understand well and scan available opportunities. Apply a checklist to evaluate potential profit, execute one purchase confidently, and document every step. Plan reinvestment of any profit into the next flip, creating a cycle that compounds over time. Start small, remain disciplined, and focus on consistent, repeatable actions. Each cycle reinforces skill, increases capital, and positions you to handle larger, more lucrative opportunities in the future. Flipping assets smartly transforms effort into a self-sustaining growth engine. By combining careful evaluation, strategic reinvestment, disciplined execution, and continuous learning, each transaction contributes to a larger compounding effect. This approach generates not only immediate income but also builds capacity for increasingly significant opportunities, creating a cycle where each action amplifies the next. The combination of skill, patience, and consistent reinvestment converts small wins into long-term financial power, demonstrating that disciplined action is the true multiplier of wealth. Number 5. Learn trends, act fast, secure gains. The ability to recognize trends and move quickly to capitalize on them is a hallmark of successful wealth builders. In every market, patterns emerge before the masses notice, and those who act decisively when they appear gain a substantial advantage. Observing trends is not about following hype blindly. It is about interpreting signals, understanding underlying dynamics, and responding with precision before the opportunity diminishes. This skill combines awareness, analysis, and disciplined execution to secure gains that others miss or cannot. Begin by developing acute observational habits. Spend dedicated time each day tracking the movements in your chosen markets. This may include price shifts, shifts in demand, news patterns, social sentiment, or emerging technologies. Document changes, noting the magnitude, speed, and context of each development. Keep a log to identify recurring behaviors or anomalies. Over time, patterns become recognizable before they reach mainstream awareness. The goal is to build a mental radar for opportunities, training both intuition and judgment through consistent, structured observation. Focus on early indicators rather than results. Trends are visible first in subtle shifts. In financial markets, These may be small volume increases or minor price upticks preceding broader moves. In product sales, it may be early adopter interest or spikes in online searches. In cultural or digital spaces, a surge of conversation or engagement can signal upcoming popularity. Learning to detect these early signals gives you the chance to act before the trend peaks, ensuring maximum benefit from timing. Develop a rapid evaluation system. When a potential trend is identified, apply a preset framework to assess its viability. This includes evaluating potential gain, risk, scalability, and alignment with your resources. By following a structured checklist, you eliminate hesitation and reduce the influence of emotion. Rapid, systematic evaluation transforms opportunities from fleeting possibilities into actionable decisions that can be executed with confidence. Act decisively once conditions are favorable. Speed is critical. The window for capitalizing on a trend is often narrow. Hesitation can result in missed gains, while premature commitment without analysis can expose you to loss. Establish clear criteria for when to enter an opportunity and follow them rigorously. Prepare all necessary tools in advance, whether it is funding, inventory, digital access, or technical setup, so execution is seamless when the signal appears. Leverage partial positions. Acting quickly does not mean overcommitting. Deploy a portion of resources to test the trend while reserving capital for adjustments or scaling. This strategy balances speed with prudence, allowing you to secure initial gains while maintaining flexibility to respond to evolving conditions. Early success can then be scaled strategically without exposing your entire portfolio to unforeseen risk. Monitor feedback continuously. Once engaged in a trend, track results meticulously. Watch for early signs of reversal or weakening momentum. Set clear thresholds for taking profits or exiting positions, and adhere to them. Emotional attachment or hope can undermine disciplined action. A systematic approach ensures gains are captured efficiently, even if the trend does not fully play out as expected. Analyze momentum drivers. Trends rarely exist in isolation. They are driven by underlying forces such as technological innovation, policy changes, demographic shifts, or social behavior. Understanding these drivers provides context for sustainability, magnitude, and timing. By analyzing the causes behind a trend, you can distinguish short-lived fads from meaningful movements that provide reliable profit opportunities. Maintain a portfolio of potential trends. Identify multiple avenues where emerging patterns could create value. Tracking several candidates simultaneously reduces dependency on a single signal and increases the probability of successful action. Allocate resources proportionally, prioritizing trends with the highest clarity, speed of development, and potential gain. A portfolio approach to trends allows you to act decisively without overexposing yourself to risk in any one area. Integrate trend spotting with other strategies. Trends often complement broader wealth-building methods. For instance, observing early shifts in consumer interest can inform product flips, digital asset investments, or service offerings. Recognizing trends enhances diversification by aligning multiple strategies with emerging opportunities, amplifying overall impact and returns. Document and learn from each action. After participating in a trend, record every decision, result, and factor influencing the outcome. Review successes and failures with the objective of refining detection, evaluation, and execution methods. Trends are dynamic. A disciplined review process accelerates learning and improves the speed and accuracy of future responses. Balance aggression with patience. Acting quickly is critical, but discernment is equally important. Not every movement is a true trend. Distinguish between noise and meaningful signals. This requires practice, observation, and a willingness to sometimes let minor opportunities pass. The combination of patience in selection and speed in execution ensures that resources are allocated to high-probability gains rather than fleeting illusions. Develop a network of insights. Connect with informed peers, forums, or communities that track emerging shifts in your area of interest. Early insights from trusted sources can accelerate detection and reduce reliance on trial and error. Focus on quality over quantity, integrating information that enhances your ability to anticipate changes rather than crowding your perspective with irrelevant chatter. Refine your exit strategies. Capturing gains requires as much planning as entering a trend. Set clear targets based on realistic projections, liquidity needs, and risk tolerance. Decide in advance under what conditions you will scale, lock in profits, or exit entirely. A disciplined exit strategy transforms a potentially profitable trend into realized gains, preventing opportunities from slipping away due to hesitation or overconfidence. Practice adaptive execution. Trends evolve rapidly, and static strategies are insufficient. Monitor changes continuously and adjust tactics as conditions shift. This could involve scaling positions, diversifying holdings within the trend, or adjusting timelines for action. Flexibility paired with discipline ensures you remain aligned with the movement without compromising principles or increasing unnecessary risk. Capitalize on compounding knowledge. Every trend you observe and act upon builds expertise. Over time, your ability to identify subtle signals, interpret dynamics, and respond efficiently improves dramatically. Knowledge compounds just like capital, increasing both speed and accuracy of future actions. Treat each opportunity as a lesson, refining your perception and execution with every experience. Control emotional responses. Quick trends can trigger excitement or fear, both of which impair judgment. Maintain focus on the system, observation, evaluation, action, and review. Emotional control allows you to remain objective, adhere to your rules, and secure gains without overextending or panicking. The steadiness of mind becomes a competitive advantage over others who react impulsively. Allocate gains wisely. Profits secured from trends should be reinvested strategically to fuel further growth or support other opportunities. Determine percentages for reinvestment, liquidity reserves, and personal use. This structured approach ensures that successful actions lead to sustainable financial expansion, creating a compounding effect over time. Test multiple markets and time frames. Trends can emerge in local, national, or global contexts, and over short or long durations. Observing and experimenting across different scopes increases the likelihood of detecting actionable opportunities. Maintain discipline to evaluate each independently and act only when clear conditions are met, avoiding overextension or distraction. Cultivate persistence and vigilance. Not all trends succeed, and some will move slower than expected. Continuous engagement, observation, and readiness to act distinguish those who consistently secure gains from those who miss fleeting opportunities. Consistency in attention and action builds cumulative advantage that far exceeds isolated efforts. Today, identify one emerging trend within your domain of interest. Spend the day observing signals, tracking indicators, and evaluating potential profitability. Prepare a checklist for decisive action, set entry and exit criteria, and plan reinvestment of any realized gains. Execute confidently when conditions align, documenting every step. This disciplined cycle of observation, action, and review builds both immediate income and long-term skill in trend-based wealth creation. Mastering trends is about combining awareness with decisive action. The process transforms fleeting signals into tangible gains, developing both financial resources and strategic acumen. By learning to identify trends early, acting quickly, and securing profits consistently, you create a dynamic system of wealth building that compounds knowledge, capital, and opportunity. Number 6. Build network, find deals, capture value. Building a network is one of the most underestimated, but powerful ways to generate opportunities, secure advantageous deals, and create lasting value. Wealth and success are rarely the result of solitary effort. They emerge from the connections, relationships, and trust cultivated over time. Every connection you make can serve as a bridge to information, resources, and opportunities that would otherwise remain hidden. Developing a network strategically allows you to access deals before they hit the broader market, negotiate from a position of knowledge, and leverage relationships to maximize returns. Start by identifying the circles that align with your goals. Focus on communities where high-quality deals partnerships, or insights are most likely to surface. These could be professional associations, local investment clubs, online forums, industry events, or informal gatherings of like-minded individuals. Choose environments where members are active, knowledgeable, and open to sharing information. Engaging consistently in these spaces creates visibility, credibility, and trust, positioning you to be among the first considered when an opportunity arises. Prioritize meaningful connections over sheer volume. A network is not a numbers game. Its strength lies in the depth and quality of relationships. Invest time in understanding people's expertise, motivations, and capabilities. Offer value before asking for anything in return. This could be sharing insights, providing introductions, or assisting with a problem. By consistently demonstrating competence and reliability, you establish yourself as someone worth collaborating with, which naturally leads to access to higher quality deals. Learn to listen actively. Gathering intelligence from your network requires more than casual conversation. Ask thoughtful questions, pay attention to what is said and unsaid, and note patterns in behavior and opportunity sharing. People often reveal insights about market trends, upcoming projects, or distressed assets in passing conversation. The ability to extract actionable information from dialogue requires patience, curiosity, and careful attention. Active listening strengthens relationships while simultaneously providing a steady stream of leads and intelligence. Document and organize your network. Maintain a structured record of contacts, including their areas of expertise, past deals, preferences, and communication history. Use a simple system to track interactions, follow-ups, and potential opportunities. Organization ensures you can act quickly when a lead arises and prevents relationships from fading due to neglect. A well-maintained network is both a repository of information and a dynamic tool for opportunity capture. Identify influencers and gatekeepers. Within any network, some individuals have access to high-value deals or critical information. Recognize who these people are, cultivate genuine relationships with them, and understand what motivates them. Approach interactions with respect, professionalism, and mutual benefit. Being trusted by key connectors often provides early access to opportunities, giving you a significant advantage over those outside the circle. Act on leads promptly. A network is only valuable when it produces actionable insights. When someone shares a potential deal or opportunity, respond quickly and decisively. Evaluate it against your criteria, perform due diligence, and make a clear decision to pursue or pass. Delays can result in missed chances, and a reputation for swift, reliable action reinforces your credibility and increases the likelihood that others will share future opportunities with you. Balance giving and receiving. Relationships thrive when they are reciprocal. While your goal is to secure valuable deals, continually provide support, advice, or introductions to others in your network. Reciprocity builds loyalty and trust, which in turn increases the flow of high-quality opportunities toward you. A generous and reliable approach encourages people to view you as a partner rather than a competitor, creating a collaborative environment in which everyone benefits. Leverage complementary skills. Seek out individuals whose capabilities supplement your own. By combining expertise, resources, or access, you can execute deals that would be impossible alone. For example, partnering with someone who has market knowledge or technical expertise can open doors to investments or projects outside your immediate capacity. Strategic partnerships amplify your reach, reduce risk, and increase the potential for profit. Continuously expand your network strategically. Avoid stagnation by actively pursuing new connections that align with evolving goals. Attend events, participate in discussions, and introduce yourself to individuals in adjacent industries or markets. Each new contact increases your probability of encountering a high-value opportunity and contributes to a more resilient and versatile network. Focus on quality additions that strengthen the structure rather than random accumulation of contacts. Develop a consistent communication rhythm. Maintain regular contact with key individuals without being intrusive. Share updates, congratulate successes, or provide insights relevant to their interests. Consistency reinforces trust and ensures that relationships remain active. People are more likely to bring you opportunities when you are engaged, present, and perceived as reliable. Identify and evaluate opportunities methodically. Not every lead is worth pursuing. Develop criteria to assess deals based on potential profit, risk, feasibility, and alignment with your resources. Prioritize opportunities that meet multiple favorable conditions and pass your evaluation framework. Being selective prevents wasted time and ensures that effort is concentrated on the highest value possibilities, maximizing both efficiency and results. Negotiate with clarity and confidence. When a lead from your network matures into a potential transaction, approach negotiations informed and prepared. Understand the interests of the other party, establish your boundaries, and structure terms that protect your investment while providing mutual benefit. Clear communication and strategic positioning increase the likelihood of capturing value without jeopardizing relationships. Document successes and lessons. Record outcomes of each deal sourced through your network, noting what worked and what could be improved. Review these insights regularly to refine your approach. Over time, patterns emerge that help identify which types of contacts, conversations, and environments consistently produce high-value opportunities. Learning from experience strengthens your network strategy and enhances future returns. Cultivate patience alongside proactivity. Building and leveraging a network is a gradual process. Relationships develop trust over time, and high-value deals often arise unexpectedly. Maintain consistent engagement, nurture connections, and position yourself as a reliable, informed participant. The combination of readiness and patience allows you to capture opportunities as they emerge, without forcing premature or ill-considered actions. Protect your reputation. Credibility is the currency of a network. Deliver on promises, maintain integrity, and avoid exploiting relationships solely for personal gain. People will continue to share opportunities with those they trust. A strong reputation ensures that access to valuable deals is sustained and grows, while lapses in judgment or ethics can close doors permanently. Integrate network insights with other strategies. Use intelligence from your connections to enhance asset flips, trend-based actions, or investment decisions. A well-informed network provides context, early warnings, and validation for opportunities identified through other methods. Combining networking with systematic analysis and execution amplifies results, creating a multiplier effect on both speed and profitability. Develop resilience in communications. Not every attempt to connect or pursue a lead will succeed. Approach rejections or silence as natural outcomes rather than personal failures. Maintain professionalism, continue engagement where appropriate, and focus on long-term relationship building. Resilience ensures you remain present in the ecosystem, ready to capture the next opportunity when conditions shift. Continuously refine approach. As your network grows and market conditions evolve, revisit strategies for engagement, opportunity evaluation, and resource allocation. Iterate on methods that deliver consistent results and eliminate those that are less effective. Continuous improvement ensures that your network remains a dynamic and valuable tool rather than a static collection of contacts. Begin immediate action by mapping your current relationships. Identify 5 individuals who can provide unique insights or opportunities, and strengthen connections through thoughtful engagement. Seek introductions to 5 new contacts aligned with your goals. Document potential leads, establish criteria for evaluating them, and prepare for decisive action when opportunities arise. This structured approach transforms a simple web of acquaintances into a system that consistently uncovers value and accelerates growth. Leveraging a network to find deals and capture value is both an art and a disciplined process. Through intentional connection, consistent engagement, strategic evaluation, and timely execution, you create an ecosystem where information, opportunities, and resources flow toward you. Over time, this system compounds, producing access to increasingly valuable deals and transforming relationships into sustained financial advantage. Relationships become not just a source of information, but a reliable mechanism for growth, security, and strategic advantage. Number 7, start small, scale quickly, reinvest earnings. Every journey toward wealth begins with a single measured step. The principle of starting small is simple yet profound. It allows you to experiment, learn, and build confidence without exposing yourself to unnecessary risk. Small beginnings provide the opportunity to test ideas, refine strategies, and gain practical experience. They transform theoretical knowledge into actionable skill while preserving capital for future growth. The real power emerges when small successes are scaled intelligently and earnings are consistently reinvested to fuel exponential expansion. Begin by identifying a manageable opportunity aligned with your resources and expertise. Choose an endeavor that is small enough to control completely, yet significant enough to provide meaningful lessons. This could be a small investment, a modest asset flip, or a micro-business project. The objective is to gain direct experience while minimizing potential losses. Starting small ensures mistakes are contained and learning is accelerated. Every small action generates feedback that informs larger decisions. Focus on execution over perfection. Initial attempts rarely proceed flawlessly, but action is more valuable than hesitation. Implement your plans systematically, observe results, and adjust continuously. A small-scale approach allows you to make corrections quickly, without catastrophic consequences. This iterative process builds skill, reinforces discipline, and sharpens judgment, laying the foundation for scaling successfully in the future. Track outcomes meticulously. Document every step, cost, effort, and result. Analyze successes and missteps with an objective lens. Small-scale efforts produce concentrated feedback, enabling rapid identification of what works and what does not. This information becomes a blueprint for replication and expansion. When scaling, having a clear record of performance metrics allows precise decision-making rather than reliance on intuition alone. Once initial results are satisfactory, scale with intention. Gradual expansion amplifies success while maintaining control. If a small investment generates consistent returns, increase the capital allocation proportionally. If a micro-business project demonstrates profit and operational stability, expand production, reach, or market exposure systematically. Scaling should always follow evidence of effectiveness. Impulsive growth introduces risk without increasing probability of success. Reinvest earnings strategically. The compounding effect of reinvested profits accelerates wealth accumulation far faster than linear growth. Decide in advance what portion of profits will return to the venture, what portion will support diversification, and what portion can be reserved for liquidity. By channeling gains back into proven systems, you create a self-sustaining cycle of growth. Each reinvested dollar multiplies potential returns, building capacity for larger opportunities. Diversify scaling methods. As you expand, consider multiple pathways to increase size or reach. This could involve geographic expansion, targeting new customer segments, adding complementary products, or applying leverage where appropriate. Strategic diversification reduces dependence on a single factor, while amplifying growth potential. Each dimension added should be backed by prior evidence and executed incrementally to maintain control and minimize risk. Maintain strict operational discipline. Scaling introduces complexity, and small inefficiencies can escalate into significant problems. Develop standardized processes, define key performance metrics, and implement routines for monitoring progress. Systematization ensures that growth is sustainable, repeatable, and efficient. Discipline in operations preserves margins, safeguards quality, and enables scalability without sacrificing control. Leverage early success for learning. As you scale, every expansion effort provides new insights. Observe which approaches yield the best results, what obstacles emerge, and how the market responds. Use this feedback to refine systems, allocate resources more effectively, and optimize timing. Scaling intelligently is not merely about increasing size. It is about enhancing the precision and effectiveness of every action. Balance speed with stability. Rapid scaling can accelerate wealth, but it must be tempered by careful management of resources, risk, and operational capacity. Ensure that each increment of growth is supported by sufficient infrastructure, cash flow, and knowledge. Hasty expansion without preparation can lead to operational breakdown, financial strain, or missed opportunities. Growth should feel deliberate, controlled, and resilient to fluctuations. Protect core capital. Starting small limits exposure, but as scale increases, maintaining a safety buffer is critical. Reserve sufficient funds to handle unexpected challenges, market changes, or operational delays. Preserving capital ensures that setbacks are temporary rather than catastrophic. Financial discipline is the bedrock of sustainable expansion and prevents early successes from being eroded by preventable mistakes. Invest in skill development concurrently. Scaling operations, investments, or business ventures requires enhanced capability. Use part of earnings to acquire new knowledge, tools, or resources that increase efficiency and effectiveness. The combination of capital growth and skill improvement creates compounding advantages, enabling larger, more complex ventures to be executed successfully. Implement a feedback-driven reinvestment cycle. Each cycle should follow a pattern. Execute on a small scale, measure results, extract lessons, scale incrementally, and reinvest profits strategically. This iterative approach ensures continuous improvement while preserving the benefits of a disciplined start. Over time, repeated cycles create exponential growth, transforming modest beginnings into substantial financial capacity. Monitor risk continuously. Scaling amplifies both potential returns and exposure. Evaluate each expansion step for operational, market, and financial risk. Establish thresholds for acceptable exposure, and adjust scaling plans if conditions deviate from expectations. Risk awareness ensures that growth remains controlled and sustainable, even in unpredictable circumstances. Capitalize on compounding psychology. Observing tangible gains from small beginnings reinforces confidence, sharpens decision-making, and strengthens discipline. Each successful iteration reduces hesitation and fear, making subsequent scaling easier and more precise. The psychological momentum of repeated achievements compounds alongside financial growth, creating both skill and capital accumulation simultaneously. Build redundancies. As operations or investments grow, identify potential points of failure and establish safeguards. This could include backup suppliers, multiple revenue channels, or diversified investment holdings. Redundancies reduce vulnerability and allow scaling to continue smoothly, even when unexpected challenges arise. Preparing for contingencies strengthens resilience and supports sustainable expansion. Focus on timing. Scaling is most effective when aligned with market conditions, demand, or opportunity cycles. Expanding too early or too late can reduce efficiency and profitability. Observe signals, anticipate shifts, and act when conditions maximize the probability of success. Timing and scaling multiplies returns while maintaining control over risk exposure. Encourage continuous evaluation. Periodically review each scaled activity for efficiency, profitability, and alignment with long-term goals. Adjust strategies, reallocate resources, and refine processes based on evidence rather than assumption. Continuous evaluation ensures that scaling remains adaptive and responsive to evolving conditions, preventing stagnation or regression. Foster discipline and reinvestment. Avoid the temptation to consume all profits prematurely. Maintain a consistent reinvestment schedule to accelerate growth. This principle applied systematically transforms modest beginnings into a robust engine of wealth creation, where each reinvested gain increases capacity for the next opportunity. Integrate small-scale experiments into broader strategy. Each initial project, even when limited in scope, provides insight into market behavior, operational efficiency, and risk tolerance. Combine multiple experiments to identify scalable systems that can be amplified. Small wins, when aggregated thoughtfully, create a roadmap for sustainable, high-return expansion. Begin immediate action by selecting one small, manageable opportunity. Execute with precision, document results, and allocate profits to reinvest in the next cycle. Scale incrementally, observe outcomes, and each cycle builds experience, capital, and confidence, creating a self-reinforcing system of growth. Starting small, scaling quickly, and reinvesting earnings transforms modest effort into exponential results. By combining disciplined initiation, evidence-based scaling, and consistent capital redeployment, you create a cycle where each action amplifies the next. The methodology converts small successes into substantial wealth, demonstrating that intelligent growth is achieved through patience, strategy, and compounding action. Number 8. Analyze data, anticipate shifts, make money. In the modern world, the ability to make money consistently is less about luck and more about understanding patterns hidden in data. Every transaction, every market movement, and every behavioral trend leaves traces of information. Those who can observe, interpret, and act on these signals gain a decisive advantage. Analyzing data is not simply about numbers. It is about extracting insight, understanding cause and effect, and anticipating shifts before they become obvious to others. Skillful analysis transforms information into actionable opportunities, creating a systematic way to generate profit while reducing risk. Start by collecting accurate and relevant data. This requires identifying the sources that provide reliable information about the markets, industries, or assets you are interested in. It may involve tracking prices, monitoring demand, following social sentiment, or examining economic indicators. The quality of your analysis depends directly on the quality of the data collected. Incomplete, outdated, or biased information can lead to misinterpretation and costly mistakes. Prioritize clarity and completeness over quantity, ensuring that every data point contributes meaningfully to your understanding. Organize the information logically. Raw data alone is not actionable. It must be structured in a way that highlights patterns and anomalies. Use spreadsheets, charts, and visualizations to map relationships and trends. Categorize by time frame, sector, or relevance to your strategic objectives. Organization reduces cognitive overload and allows faster identification of meaningful insights, giving you the ability to act decisively when opportunities arise. Focus on patterns rather than individual data points. While single events can be informative, true predictive power comes from recognizing recurring signals. Analyze historical trends to understand how certain variables interact over time. Detecting cycles, correlations, and thresholds enables you to anticipate future movements rather than react impulsively. The ability to see beyond isolated events distinguishes strategic decision-makers from reactive participants. Interpret the underlying drivers. Data only tells part of the story. Understanding the forces behind it is essential. Economic policies, consumer psychology, technological innovation, and social trends all shape outcomes. By analyzing not just the numbers but the context, you can anticipate shifts that others might overlook. Insight into causal relationships allows proactive positioning, giving you first-mover advantage in capturing opportunities. Develop predictive models. These do not need to be complex algorithms at first. Simple frameworks that estimate likely outcomes based on observed patterns can provide valuable guidance. For example, tracking seasonal fluctuations, price elasticity, or historical cycles can help forecast demand or market movement. Over time, refine models using results from previous decisions, improving accuracy and confidence in predictions. Integrate multiple data sources. Relying on a single indicator limits perspective and increases vulnerability. Combine financial data, market sentiment, competitor activity, and macroeconomic factors to create a holistic view. Cross-referencing signals increases the reliability of predictions and reduces the risk of false positives. The convergence of multiple indicators strengthens conviction and informs decisive action. Anticipate shifts rather than chase trends. Most profit comes from positioning yourself ahead of change, not reacting once it is obvious. Use data to detect early warnings of shifts in demand, pricing, regulation, or consumer behavior. These signals often appear before broader recognition and can be subtle. Recognizing them early allows entry at favorable points and exit before trends reverse, maximizing profitability. Measure risk rigorously. Predicting shifts carries inherent uncertainty, and no analysis is perfect. Assess potential downside, volatility, and exposure before committing resources. Use data-driven thresholds to determine acceptable risk levels, stop-loss points, and contingencies. Analytical discipline ensures that gains are captured while losses are controlled, creating a balanced approach that preserves capital for future opportunities. Act decisively once insight is confirmed. Analysis without execution is worthless. When data indicates a high-probability opportunity, move promptly and efficiently. Timing can be as important as accuracy. Hesitation can erode the advantage gained from insight. Prepare resources, align strategy, and execute with confidence, ensuring that potential gains are realized rather than left on the table. Monitor results continuously. Once a decision is implemented, track outcomes and compare them with predictions. Identify deviations, assess reasons, and adjust models accordingly. Continuous feedback strengthens analytical skill, improves future anticipation, and reinforces a disciplined approach to opportunity capture. Learning from every action enhances both speed and accuracy over time. Balance quantitative and qualitative inputs. Data provides measurable signals, but intuition and experience are critical for interpretation. Contextual understanding, market nuances, and behavioral insight complement numeric analysis. Incorporating both perspectives reduces over-reliance on mechanical calculation and increases the probability of correctly anticipating changes. Systematize observation. Create routines for data collection, analysis, and action. Allocate consistent time for monitoring key indicators, updating models, and reviewing decisions. Systematic practice embeds analytical thinking into daily activity, allowing insights to emerge naturally rather than sporadically. A disciplined routine ensures continuous awareness and readiness to capitalize on shifts. Leverage technology effectively. Tools for data tracking, visualization, and alerting can increase both speed and accuracy. Automated monitoring reduces the risk of missing subtle signals and provides actionable intelligence in real time. Choose technology that complements your understanding rather than replacing judgment. Effective use of digital resources amplifies insight while preserving human decision-making. Refine decision criteria. Use historical analysis to define thresholds for action. Determine which patterns reliably predict profitable outcomes and which are misleading. Establish clear rules for entry, exit, and allocation based on statistical confidence, trend strength, and risk assessment. Consistency in criteria prevents emotional impulses from undermining analytical advantage. Identify correlations and dependencies. Understanding how variables interact allows for better prediction of cascading effects. For instance, a shift in one market may influence related sectors or assets. Mapping interdependency enhances foresight and prepares you to respond strategically, not just reactively. Anticipation based on relational insight increases the likelihood of profitable moves. Integrate short-term and long-term perspectives. Some data reflects immediate opportunities, while other patterns indicate emerging trends over months or years. Balancing horizon perspectives allows capitalizing on immediate gains while positioning for sustained growth. A multi-horizon approach maximizes resource efficiency and strengthens resilience to unforeseen market fluctuations. Foster a mindset of continuous curiosity. Analytical skill improves with engagement, observation, and reflection. Treat each data set as a puzzle, seeking not just answers, but understanding of underlying mechanism. Curiosity drives deeper insight, which enhances the ability to anticipate change and identify unique opportunities. Document lessons comprehensively. Every analysis, prediction, and outcome should be recorded systematically. Evaluate accuracy, reasons for deviation, and potential improvements. Over time, this creates a reference library of knowledge that accelerates both recognition of patterns and execution of profitable actions. Historical insight transforms repeated experience into compounded skill. Combine multiple income-generating applications. Insights derived from data can inform asset flips, trend exploitation, investment allocation, or strategic partnerships. Applying analysis across diverse opportunities amplifies returns and reduces reliance on a single avenue. Analytical rigor, when applied consistently, creates multiple streams of revenue, each reinforced by the others. Maintain flexibility in response. Even the most rigorous analysis cannot guarantee certainty. Conditions can shift unexpectedly. Be prepared to adjust strategies, exit positions, or reallocate resources promptly. Flexibility ensures that data-driven decisions remain profitable in dynamic environments, preventing losses from rigid adherence to outdated predictions. Take immediate steps by selecting one focus area. Gather relevant data, document historical trends, and develop a simple predictive model. Identify potential shifts and establish clear criteria for action. Execute with precision when conditions align, and track results carefully to refine future analysis. The disciplined application of observation, interpretation, and execution creates a reproducible cycle of profit generation. Analyzing data, anticipating shifts, and acting strategically transforms information into tangible financial advantage. By combining meticulous observation, predictive insight, and disciplined execution, wealth creation becomes systematic rather than accidental. Mastery of data interpretation not only identifies current opportunities, but builds foresight, allowing the capture of value continuously as markets and conditions evolve. This skill converts complexity into clarity and potential into profit. Number 9. Focus on high demand, fast turnaround investments. In the world of wealth building, speed and demand are often the deciding factors between a successful investment and a missed opportunity. High demand, fast turnaround investments offer a unique advantage. They allow capital to circulate quickly, generate repeated returns, and reduce exposure to long-term uncertainty. By focusing on opportunities that move swiftly and meet immediate market needs, you maximize both efficiency and profitability. This approach demands discipline, market awareness, and decisiveness, transforming financial activity from a slow accumulation into a dynamic engine of growth. Begin by identifying sectors or assets where demand is consistently high. These are areas where buyers or users actively seek products or services and are willing to act quickly. Such opportunities often emerge in trending consumer goods, popular digital products, emerging technologies, and short-term financial instruments. The key is to pinpoint investments that naturally attract interest and where liquidity is high. High demand ensures that transactions can occur quickly, minimizing holding time and freeing capital for the next opportunity. Assess turnaround potential. A fast return investment is one where the time between acquisition and realization of profit is short. Evaluate market cycles, typical transaction times, and ease of transfer or resale. Short turnaround investments reduce exposure to volatility and allow repeated application of capital, creating a compounding effect over time. The faster your capital completes a cycle, the greater the number of cycles possible within the same time frame, multiplying returns efficiently. Prioritize liquidity. Assets that can be converted to cash or profit quickly reduce the risk of stagnation and unexpected loss. Evaluate how easily an investment can be sold or monetized. Liquidity is particularly critical in dynamic markets where conditions can change rapidly. By focusing on assets that are actively traded or in continuous demand, you ensure flexibility and preserve the ability to respond to new opportunities without being locked into slow-moving positions. Evaluate risk relative to speed. Fast turnaround investments are appealing, but they often carry risks associated with volatility or oversaturation. Analyze potential downside, market stability, and historical performance to understand the balance between speed and security. Applying calculated caution prevents small losses from negating the benefits of rapid capital circulation, while maintaining the agility necessary to capitalize on emerging opportunities. Leverage trends to enhance demand. Emerging consumer behavior, technology adoption, and cultural shifts often create temporary windows of heightened interest. Track social media activity, search trends, and market buzz to anticipate which products, services, or assets will experience peak demand. Acting early allows acquisition at favorable entry points and timely realization of profit before the trend dissipates. This strategy transforms observational skill into tangible financial advantage. Streamline operational processes. Speed requires efficiency, whether it involves product sourcing, digital delivery, or financial execution. Reduce friction at every step. Automate routine tasks, standardize workflows, and eliminate delays to ensure that opportunities are acted upon immediately. Operational agility enhances profitability by minimizing the time and cost associated with moving capital from one transaction to the next. Focus on repeatable systems. High demand, fast turnaround investments are most powerful when executed consistently. Develop frameworks for identifying, evaluating, and executing opportunities reliably. Create criteria for entry, target returns, and exit points. By applying structured methods, you can replicate success across multiple investments rather than relying on sporadic luck or intuition. Predictable execution transforms volatility into a source of repeated gain. Capitalize on small margins with high frequency. Fast turnaround investments often yield smaller individual profits, but the rapid repetition of successful cycles generates substantial cumulative returns. Focus on volume and efficiency rather than seeking single outsized gains. Each completed cycle increases both capital and experience, accelerating growth over time. This approach emphasizes compounding action as a primary driver of wealth. Monitor market conditions continuously. Fast-moving opportunities are highly sensitive to shifts in demand, competition, and sentiment. Maintain a disciplined schedule of observation and analysis to identify changes in real time. By staying informed, you can exit positions at optimal moments, avoid losses from rapid reversals, and redeploy resources into the next opportunity with minimal delay. Vigilance ensures that speed does not compromise judgment. Develop a network of high-demand sources. Cultivate relationships with suppliers, market insiders, or informed participants who can alert you to upcoming opportunities before they are widely available. Early access enables acquisition at favorable prices and improves the likelihood of successful, fast turnaround. Networking creates an informational advantage, increasing both speed and reliability in executing transactions. Evaluate cost and time efficiency. Every investment carries a resource cost beyond capital. Consider logistics, effort, and fees associated with acquiring, managing, and selling the asset. Minimize these expenditures to enhance net return per cycle. Investments that require extensive time or energy reduce the benefits of rapid turnover. Streamlined operations allow more cycles to be completed within the same time frame, maximizing compounded gains. Adapt quickly to changing demand. High-demand markets are dynamic and often short-lived. Be prepared to pivot as interest shifts or new trends emerge. Exit declining opportunities promptly and redeploy capital into areas with renewed interest. Flexibility amplifies efficiency, ensuring that each investment cycle captures maximum potential rather than becoming mired in stagnation. Leverage data-driven decisions. Track performance metrics for each fast turnaround investment, including acquisition cost, time to completion, net profit, and market behavior. Analyze patterns to identify which approaches consistently yield success. Data allows refinement of strategies, reduces reliance on guesswork, and informs decisions about scaling, diversification, and timing. Continuous learning transforms experience into predictive capability. Apply risk controls rigorously. Fast-moving opportunities can tempt overcommitment or excessive leverage. Define clear thresholds for maximum exposure, acceptable loss, and profit-taking. Maintain discipline even when momentum feels overwhelming. Protecting capital ensures sustainability, allowing repeated engagement in high-demand investments without catastrophic setbacks. Reinvest profits intelligently. Gains realized from rapid cycles can fuel subsequent opportunities, creating a compounding effect. Allocate a portion for reinvestment, a portion for diversification, and a portion as a reserve to support agility. Consistent reinvestment magnifies the power of short-cycle returns and builds a growing engine of wealth over time. Prioritize quality over hype. Not every popular asset or trend provides genuine return potential. Assess demand sustainability, ease of transaction, and exit options carefully. Avoid chasing ephemeral fads that generate attention but offer minimal profit or high risk. Focus on investments where interest translates directly into tangible, realizable gains. Use multiple avenues for deployment. High-demand, fast turnaround strategies can be applied across markets, products, and instruments simultaneously. Diversifying within this framework spreads risk while maintaining rapid capital movement. By executing multiple opportunities in parallel, overall profitability increases without sacrificing speed or efficiency. Maintain psychological discipline. Fast cycles create pressure and excitement, but decisions must remain grounded in logic and evidence. Avoid impulsive acquisitions, emotional reactions, or chasing unrealistic returns. Discipline ensures that speed and demand are leveraged effectively, rather than undermining strategy through poor judgment. Track competitor behavior. Observing how others act in high-demand markets can provide insights into pricing, timing, and emerging opportunities. Anticipate competitive moves and position yourself advantageous. Early recognition of shifts in competitor activity allows proactive adjustment of strategy, enhancing both speed and return potential. Plan exit strategies meticulously. In rapid turnover investments, determining the precise moment to realize gains is critical. Predefine exit conditions based on price, timing, and market signals. A clear plan prevents hesitation or second-guessing, ensuring that profits are captured efficiently and capital is available for the next opportunity. Take immediate action by selecting one high-demand opportunity. Evaluate its potential for rapid turnaround, set clear acquisition and exit criteria, and allocate resources to execute. Monitor outcomes, document lessons, and redeploy earnings promptly. Repetition of this cycle builds skill, accelerates capital growth, and establishes a system where speed and demand consistently generate value. Focusing on high-demand, fast turnaround investments transforms effort into a recurring engine of profit. By combining market awareness, operational efficiency, disciplined execution, and strategic reinvestment, each cycle compounds gains and sharpens skill. Speed, when harnessed with precision, amplifies opportunity, reduces exposure, and converts fleeting trends into sustained financial growth, demonstrating that the ability to act quickly on demand-driven investments is a cornerstone of wealth creation. Number 10. Save aggressively, invest strategically, grow wealth. Building lasting wealth is a process grounded in disciplines, strategic planning, and consistent action. It begins with the habit of saving aggressively. Saving is not merely setting aside leftover money. It is a conscious decision to prioritize your financial future over immediate gratification. Each dollar saved represents a unit of freedom, opportunity, and leverage. The power of accumulation comes not from occasional restraint, but from steady, unwavering commitment. By consistently diverting income towards savings, you create a foundation that allows you to invest strategically, capitalize on opportunities, and grow wealth over time. Start by examining your income and expenses in detail. Identify areas where spending can be reduced without diminishing your quality of life. This requires honesty and precision, separating wants from needs and eliminating unnecessary expenditures. Automate savings so that a portion of every paycheck is directed immediately into dedicated accounts. Automation removes the temptation to spend and ensures that accumulation occurs consistently, laying the groundwork for future investment. Develop a mindset that views saving as empowerment rather than sacrifice. Every dollar conserved is an instrument of potential. Shifting perspective transforms the act of saving into a motivating force, reinforcing self-discipline and a long-term vision. When saving becomes habitual, it no longer feels restrictive but becomes a natural component of daily life, creating a reservoir of capital to deploy strategically. Strategic investing is the bridge between saved capital and wealth creation. Saving alone preserves value. Investing multiplies it. Investments should be chosen based on objective criteria: risk, potential return, liquidity, and alignment with personal goals. Diversify holdings across multiple sectors or asset types to spread risk while maintaining growth potential. Diversification protects capital from unexpected setbacks, while ensuring that opportunities for compounding returns continue uninterrupted. Analyze investment options rigorously. Study historical performance, market dynamics, and economic indicators. to understand potential outcomes. Avoid impulsive decisions driven by hype or emotion. Strategic investment requires both patience and precision, combining careful evaluation with timely execution. The goal is to place capital where it can grow consistently and sustainably, rather than chasing fleeting gains that carry disproportionate risk. Reinvest earnings consistently. Profits from investments should not merely be consumed. They are the fuel for exponential growth. Reinvestment allows wealth to compound, turning modest initial sums into substantial capital over time. Establish a reinvestment schedule and allocate a defined portion of returns back into productive assets. By applying discipline to this process, financial growth accelerates, creating a self-sustaining cycle of wealth accumulation. Maintain a balance between security and opportunity. Strategic investing involves a careful assessment of risk relative to potential reward. Preserve a portion of capital in secure, low-volatility instruments to safeguard against market fluctuations, while deploying other portions into higher return opportunities. This balance protects wealth while enabling growth, ensuring that setbacks do not derail long-term objectives. Focus on long-term horizons. While tactical opportunities may arise, the foundation of substantial wealth is patience. Investments that grow steadily over time, whether through interest, dividends, or appreciation, form the backbone of sustainable prosperity. Avoid the temptation of short-term speculation that sacrifices long-term compounding. Strategic foresight ensures that decisions made today multiply returns in the years to come. Track all financial activity meticulously. Document income, expenses, savings contributions, investment allocations, and returns. An accurate record provides insight into performance, highlights areas for improvement, and supports informed decision-making. Tracking is not merely administrative. It reveals patterns, guides strategy, and reinforces accountability, ensuring that every financial move contributes to the overarching goal of wealth accumulation. Continuously educate yourself. Financial literacy is a force multiplier for saving and investing. Study market trends, asset classes, and economic principles to improve the quality of your decisions. Knowledge reduces reliance on luck and enhances the precision of execution. An informed investor can navigate uncertainty with confidence, identify emerging opportunities, and anticipate risks before they materialize. Adopt a disciplined approach to spending. Even as savings grow and investments yield returns, lifestyle inflation can erode progress. Resist the urge to expand expenditures proportionally with income. Maintain a focus on value, purposeful consumption, and financial priorities. The discipline to live below your means while increasing wealth amplifies the impact of both saving and investing. Leverage tax efficiency. Understanding the tax implications of savings and investments enhances net growth. Utilize tax advantage accounts, deductions, and investment vehicles that maximize returns while minimizing unnecessary taxation. Strategic planning ensures that earned wealth is preserved and reinvested rather than diminished by avoidable costs. Regularly review and adjust your strategy. Markets, personal circumstances, and goals evolve over time. Periodically assess asset performance, risk exposure, and financial objectives. Adjust allocations, contributions, and targets to reflect current conditions while remaining aligned with long-term plans. Flexibility combined with consistency ensures that wealth-building efforts remain optimized and resilient. Develop multiple streams of growth. Relying solely on a single income source or investment type limits potential. Diversify across employment income, investment returns, business ventures, or passive income streams. Multiple avenues of growth create redundancy, increase stability, and accelerate wealth accumulation by leveraging different sources simultaneously. Adopt a mindset of compounding. Understand that small, consistent actions produce enormous results over time. The combination of disciplined saving, strategic investing, and reinvestment creates a multiplier effect. Each cycle builds upon the last, transforming modest beginnings into substantial assets. The compounding principle rewards persistence and consistency, reinforcing the importance of sustained effort. Protect your capital proactively. Insurance, legal safeguards, and contingency planning mitigate risk, Capital preservation ensures that savings and investments are not eroded by unforeseen events. Strategic wealth growth is inseparable from the proactive protection of accumulated resources, allowing opportunities to be pursued confidently without jeopardizing security. Leverage opportunities selectively. As capital grows, access to larger investments becomes possible. Prioritize opportunities with favorable risk-reward profiles and clear potential for compound growth. Apply rigorous evaluation criteria to ensure that every deployment of funds aligns with long-term objectives and contributes meaningfully to overall wealth expansion. Cultivate patience and resilience. Wealth accumulation is a marathon, not a sprint. Market fluctuations, unexpected expenses, or temporary losses are inevitable. Resilience allows you to maintain discipline in saving and investing, avoiding reactionary decisions that compromise long-term growth. Patience ensures that compounding benefits are fully realized, and setbacks become learning opportunities rather than permanent setbacks. Encourage accountability and review. Share goals with trusted advisors, mentors, or financial partners. External accountability reinforces discipline, provides perspective, and encourages strategic thinking. Regular reviews with others can reveal blind spots, highlight overlooked opportunities, and reinforce commitment to saving and investing principles. Start immediate application by allocating a fixed percentage of income to savings. Research suitable investment vehicles aligned with risk tolerance and long-term goals. Implement reinvestment strategies for any earnings and document every step for review. Establish periodic evaluations to adjust strategy, ensuring that each action contributes to sustainable growth. Saving aggressively, investing strategically, and reinvesting earnings form the bedrock of wealth creation. Through discipline, foresight, and calculated action, financial growth becomes systematic rather than arbitrary. This combination transforms limited resources into increasing capital, amplifies the impact of each financial decision, and ensures that wealth is built sustainably over time. By mastering these principles, long-term prosperity becomes a natural outcome of consistent, intelligent effort.